Good evening, everyone. How's everyone doing? Back once again. So, as I go live tonight, basically, title of this live is "Are you paying too much taxes?" So the reason why I put that in the title because one of my clients called me today, and so they text me and she actually said, "Marvin, I'm I got an increase on my job, so now I know that." Last year, when you did my taxes, I got back very little. As I explained to her that one, based on her income and based on her filing status. So her filing status last year was single. So the standard deduction for single filer last year was $13,580. So she made well over 70,000, but her standard deduction, her filing status was single, and her standard deduction for filing status single was 13,580. Minus that, now you have what you call your taxable income. Now, your taxable income are in certain brackets from 0 up to 37%. So we live in what they call a progressive tax. Progressive tax means the more you make, you fall into a different bracket. So you're going to be taxed more. So she's an employee. So she works, she has a job. She's an employee. So some of this conversation would not apply to those who are self-employed, who owns a business, who owns a business. I'm talking about those who are employees of a company because there's a difference in employee, self-employed, and a business and an investor. They're all taxed different. So I'm going to keep it very simple. So when she spoke to me today, she said to me, I got a raise. So what I want to explain to a lot of you out there is one thing that you guys do is majority of most people, they're looking for a refund and they're looking to pay the cheapest cost possible. So what they'll do is they'll go and do the tax return themselves through either Free USA, Credit Karma, TurboTax. They'll even go online to H&R Block and other online tax softwares that they'll use because they don't want to pay the cost to come to myself, a tax accountant who's a tax professional, or any other tax professionals, such as tax accountants, CPAs, and enroll agents, and tax preparers. So they don't want to pay the cost. So now here's the question I have for each and every one of you. Those one of the biggest problems that we have, and that I always tell people is this: growing up as children, no one ever, your parents, your school teachers, your family, or your friends did not teach you about taxes and credit. You didn't learn about this at church. You didn't learn about this in public, middle, and high school and college. You took up accounting at college, but you got, unless you went to college, took up accounting. So majority of most people are uneducated when it comes to credit and taxes. And everyone is not held to the same standard when it comes to taxes. So when she called me today, she's like, Marvin, I got a new job. Not a new job. I got a raise on my job. So a raise came late towards the end of the year. It all depends on your job. Some jobs give out a raise at the beginning of the year after they do their annual review. There's some jobs will do it after the first quarter, after March. It all depends on the job and their policies when it comes to giving out any type of increase in any type of benefits, such as a health savings account, a 401 account, a group life insurance, supplemental insurance such as dental, and vision. So they decide when they're going to offer these salary increase and other benefits that come along with the job. So she said to me that she got a raise. Now the issue with her was last year. Remember, she made over 70,000. Her filing status was single. She had no dependents. So now what happens is she falls into a different bracket. So her income tax rate bracket from 0 to 59,000 to 60 put at a 22% marginal tax rate. After you take her gross income minus her standard deduction, 13,580, what's left over was her taxable income, which was well over $59,000. So with that said and done, we talked for a while and she was texting me. And one thing that I mentioned to my clients is that what is tax planning or tax advisory? Tax advisory is tax planning, which are strategies that will help reduce your taxable income, one part of it. You can talk about the tax credits. And on the state side, we can talk about the 529 plan, college saving plans, which help on the state side. And also on the state side, that depends on what industry you're working in. If you're a lawyer, then there's some states that allow you to write off reimbursable expenses. Expenses that expenses, out-of-pocket expenses for your job. For example, if you was a lawyer, there might be, for example, continuing education. You might go to court and park your car, parking fees. You might have to travel to another part of the city, which is traveling, which is easy pass or tolls and gas. So these are called out-of-pocket expenses in regard to your job that you can write off. As far on the state level, on the Schedule 1, which is called a Schedule A, you can write off expenses related to the job. So she has no dependents, she has no dependents, whether it's children or other dependents such as parents, aunts and uncles, cousins, those that are dependent with you and live with you. So those are considered other dependents. And then you have qualifying dependents, which are your children. So there's two types of dependents: other dependents, which are family members, and then you have your children from 17 and below, which are your own children. These are the dependents as far as the earned income credit that you get $2,000 per child. So she has no dependents. So there's not much to write off because she don't own a house. So when you own a house, you can write off the mortgage interest and the property tax, which they call the SALT tax, which is the state and local tax. Is capped off at $10,000. So now, and she didn't really have no itemized deductions. So let's say, for example, her standard deduction is $13,580, but her itemized deduction or more. Let's say her itemized deduction total $25,000. So now you're going to choose the itemized deduction over the standard deduction because it's more. And there are certain cases. So as I mentioned, I'm going to keep it simple. So she asked a lot of questions in the text. So we practically for like about a half an hour, or something like that, we started going back and forth. So one of the things I asked her was, first thing is, when you fill out your W-4, that's the first thing. So you want your allowances to be, withholding allowance to be zero. Zero meaning take out more taxes. Now, a lot of people, for two reasons, what they'll do is they'll claim their dependents. They might claim, let's say they'll claim their dependents, right? So they'll put one, let's say they have three dependents. So they'll claim their three dependents. They'll come home with more take-home pay, but at the end of the year, guess what? They didn't pay enough taxes, federal taxes. So they didn't pay enough taxes. So there was an underpayment in taxes because why? They claimed their dependents in January to have what? A more take-home pay, to have more money that they could take home. Some people also do that because if they're living paycheck to paycheck, because of inflation nowadays, people have very little money. After you deduct all their deductions from their paycheck, I'm going to give you some of them. Child support. A lot of you have garnishment from child support. You owe state taxes. So now they're garnishing your paycheck for back child support. They're garnishing your paycheck because you have not paid the state taxes. So now the state taxes now send a letter to the payroll office to now garnish your wages through payroll. So now you can pay off your state taxes that you owe. Some even city and local taxes will do that. Other deductions, 401k deductions, health savings account deductions, right? So now many people have a lot of deductions taken out of their paycheck, but bringing home very little after all the deductions. So now they're going to claim their dependents, and what's going to happen? They're going to pay very little in taxes while bringing home a lot more on their paycheck. But guess what? They don't realize that they're underpaying in regards to taxes. So when they go do their tax return, what you think is going to happen? They're going to owe. They're going to owe. So as I spoke to her, one thing that I bring to my clients is tax planning. What is tax planning? How to reduce your taxes legally through the IRS tax laws. How to reduce your taxes legally through the IRS tax laws and tax codes. How to get the credit, right? And the strategies that you can use to lower your tax bill during the year and after the year. So tax planning starts what? Once you file the tax return, let's say in February. Tax planning don't start in October, November, December, because now you're in the fourth quarter. What is the fourth quarter? October, November, and December. Now it's going to be a little too late. So there's going to be a likelihood that you're going to owe. But yet I have told you, once you file your tax return, we offer another service called tax planning. A lot of you don't want to invest into education. And the main thing, a lot of you don't invest into yourself. And I tell everyone, life is a classroom. We almost pay tuition. So when you don't invest into yourself, what do you expect the outcome to be? Are you here's the outcome, and this is your reaction. Your reaction is based on the outcome for your lack of knowledge and not investing into yourself. So now you want to walk around angry. And you want to blame everybody, but you don't blame yourself because you don't invest into yourself. You don't invest to learn. You want to pay the cheapest cost and the least resistance, yet you always get the same outcome over and over and over. When do you stop and say, wait a minute, why? When you start asking the question why, now you are going to seek the answer from a place of what? Logic, not emotions. See, a lot of you can't think your way through your problems. Your problems overpower you and overtake you. So logic don't exist and common sense don't exist. So as I mentioned to her, was one thing I said to her, for anyone that I do taxes for, and I have clients throughout the United States, is we have a portal, a client portal. What is the client portal? The client portal is where you upload all your documents into this portal, which is safe, versus emailing it across the internet. And I'll tell you why. You should never email your W-2. And the reason why I mentioned that, before you email your W-2, your Social Security should be masked, M-A-S-K, masked on your W-2 when you get to the end of the year. That is for identity theft protection. Years ago, when it was coming up, they would show you a 9-digit Social Security number. Nowadays, your Social Security number should be masked, which means the first 5 are masked. It'll say XXX dash XX dash 0123. 0123. It should show the last 4 of your Social Security number. So the word mask means they're not showing your whole Social Security. They're not showing all of your Social Security number, which are 9 digits. Why? Because for identity theft protection. So nowadays, your W-2s or your 1099s come with your Social Security number mask or even your EIN number mask. So if it's masked, it's going to look like this. XXX dash XX0123, and it's going to show the last 4 numbers, and in front of those last 4 numbers is going to be X, 5X, XXX dash XX dash 0123, which is going to show your last 4 numbers. So that's your Social Security number is masked on your W-2. Now, the other reason why, even if it's masked, you should not email the W-2, and I'll tell you why. Because you have your job or your employer EIN, Employee Identification Number, which is a 9-digit number. So someone can intercept that and use your job EIN number and open up certain accounts. So that's why you don't email across the net. So one of the requirements that I'm supposed to do is to safeguard my client's information. And the way I do that is we have what they call practice management software, which creates a client portal for you to upload your documents, your Social Security, your driver's license, your W-2, your mortgage statement, your 1095A, which is from the health savings for the marketplace for your health insurance, your brokerage accounts, such as your stocks, your mutual funds that you get from either Robinhood or Fidelity or Principal Financial, whomever you have your brokerage accounts with, you're going to upload all this information into a portal, my portal. And then from there, I will, along with my staff, we will retrieve the information and break the information down based on the tax documents by the year. And your driver's license with your identification, we will break all these things down so it's safe and secure. You should never email or even take photos of your documents. If your phone don't have a PIN, that every time you open up your phone, you have to put in a PIN number, a personal identification number, in order to proceed to your phone, either to make phone calls or to your apps or your phone. So what I did was I told her to upload her pay stub, her most recent pay stub. Now, this is the thing that I'm seeing that a lot of you out there, we have been conditioned by going paperless that many of our documents is 2 ways we retrieve them. We either go online to our bank through online banking, and we retrieve our checking account statements, our savings account statements, our money market account statements, our business checking, business credit cards, our credit card statements. Those who have a mortgage through the banks, now you can go online to your account and retrieve your 1098 mortgage statement. A lot of you that get unemployment, you will go to unemployment and pull your unemployment what's that? It'll come to me. Your unemployment statement, so you can file that on your tax return. Those that got unemployment or your 1099 SA Social Security Administration, you can go online and pull. So now, majority of the documents you no longer get in the mail anymore. So you have to go online and retrieve these documents. And many people are not computer literate. So the older the generation is, they're going to find it hard if they don't have no assistance on pulling their documents, such as their 1099-R, which is their retirement, their pension that they get every month. So at the end of the year, you get a 1099-R for annuities and retirement. That you could retirement funds that you collect over the year. A lot of people get Social Security from when they work. So they get their 1099 SA, Social Security Administration statement. That comes in the mail. So they'll need that Social Security statement, 1099 SA, and they'll need their what? 1099-R for their retirement or annuities that they receive on a monthly basis. So one of the things with her was she had got a raise. So she reached out to me today because she just recently got the raise. So that meant that she was going to make more money. Remember, last year she only got a federal refund of less than $3. Why? Because her filing status, which was single, she made over $70,000. She had no dependents. She did not own a house and receive a mortgage statement, and you can write off the interest and the property taxes. So basically, she had nothing. Now, one of the things I told her to do was I wanted to see her pay stub, her most recent pay stub. Why? What was I looking for? I wanted to look at her allowances. What does that mean? When you fill out your W-4, when they ask you for your federal withholding allowance and your state withholding allowance, in some states it's federal and state, and you have local taxes. And normally you put down 0. When you put down 0, you are going to pay more taxes, and you're not going to bring home a lot of take-home pay. If you claim 3 dependents, you are going to pay less in taxes on the federal and state level, but you're going to have a more take-home pay. Why? Because sometimes, as I mentioned, because of inflation, many people are living paycheck to paycheck. So they need all the money that they can, but what's going to happen on the end when they file their taxes, there's a likelihood that they're going to owe. So when I said to upload the W-2, so I want to look at her federal withholdings, because she lives in Jersey, but she works in New York, right? So she's being taxed both places on the state level, and on the federal level, I want to see. So it said federal withholding 0, okay? New York withholding 0, and New Jersey withholding 0. So that's fine. Now, what I mentioned to her was, I asked her, are you taking advantage of all pre-tax? What is pre-tax? Pre-taxes are withholdings taken out before you get taxed. Pre-tax means deductions that are taken out, then you get taxed on your gross salary. Deductions taken out of your gross salary, which is not taxed. So deductions that are taken out, which are not taxed, once those deductions are taken out, then you are taxed on what your gross salary, whatever's left. So let me give you an example of pre-tax. Many of you are participating in your job 401k. So you elect to hold back 3% of your gross every 2 weeks. So that's money taken out. So let's say you withhold $100 for your 401k every 2 weeks. Another pre-tax is many of you have a high deductible health plan. Again, many of you have a high deductible health plan. So what your job do to offset that is they give you a HSA, which stands for Health Savings Account. So the money that goes in, money that your job puts in is tax-free money. And when you spend it on qualified medical expenses, you don't pay taxes on that. So I'll go into that early. So now let's say you elect to hold out the maximum contribution for health savings account for single for the year 2024, as I told her, what is $4,150. Again, the maximum contribution, if you're a single filer and you're a single filer, the maximum contribution for a health savings account, and the acronym for that is HSA, which stands for Health Savings Account, is $4,150 in 2024. And if you're 55 years old, 55 and older, you have something called catch-up contribution, which you could contribute an extra $1,000. And for married filing joint, or for a family, married filing joint, the maximum contribution is $8,300. And if you're 55 and older, you get to pay what they call a catch-up contribution, additional $2,000. That's $10,300. So with that said and done, that's pre-tax, right? So let's say, for example, I'm going to give you an example. Let's say you gross and you take out 3% of your gross, right? So let's say you made $2,000, and you elect to withhold 3% of that from your gross earnings. Your gross earnings before deductions. So gross earnings is $2,000, and you get paid every 2 weeks. $2,000 is your gross times 3% is $60. Minus that, now that $60 is being taken from your gross. Now you're left with a gross of $1,940. You have not been taxed yet. That's why they call it pre-tax, before deductions. Before deductions. Now you're left with $1,940. So that decreased your income by what? $60, where it's pre-tax. You're not paying taxes on that yet until you withdraw it two ways. If you withdraw it before 59 years old, you are going to get penalized 10%. But if you pay it back in 60 days, you can avoid that. So now you elect to hold 3% of your gross salary of $2,000 every 2 weeks, which is $60. And you elect to withhold, let's say, for example, $100. I'm being hypothetically, $100 a paycheck for HSA minus 100. Now you're down to 1,840. Now here come your tax deductions off the 1,840. So you're being taxed off the gross of $1,840. So when it says pre-tax, this is money that's taken out before there are deductions. So now you are putting $60 every 2 weeks into your IRA account, which means individual retirement account. What is it called? A 401k. Now your job is going to match that at 3%. They'll match what you put in. So if you put in 60, they're going to match it with $60. It also depends on the maximum that you're allowed to withhold and the max of how much they're going to match. So now your job is going to put in 60. You're going to put in 60. How much is that? $120 every 2 weeks, which is $240 a month, right? Now, and I also mentioned about the HSA, which is $100. So Now you're being taxed on 1,000. Your gross 1,840. So now you're gonna be taxed on that. So when I looked at her pay stub, I saw her pre-tax and her post-tax. Post-tax is after all the deductions. After all your deductions, now it's called a post-tax. Post-tax is after all your deductions that are taken. So I'm going to give you a post-tax IRA, which will be the Roth IRA. It's a post-tax versus the 401k, which is pre-tax. And there's a difference, and I'll talk about that later on. So one thing I mentioned to her was, are you taking advantage of, for example, do you have a 401k? And she said, yes. I said, no, it's not here. Because her pay stub was broken down. And they had it broken down pre-tax dollars, post-tax, federal, state, local. It was broken down beautiful. It had her allowance at zero. It was one of the best pay stubs that I've seen. So it was broken down. But I understood it. She didn't. What else? She never looked at her pay stub. Many of you don't look at your pay stub. All that you care about is every week or every 2 weeks that your paycheck is going into either your bank account or your credit union or your debit card. Well, however you get your direct deposit, whether it's weekly or bi-weekly, that's all you care about. But many of us don't look at the pay stub for two reasons. One, many companies don't have an on-site HR no more. So each employee are given them what they call an employee portal, where now you go up there, you have an employee portal from ADP or Pay, and each one of you create your own username and password where you can go retrieve your W-2s, your W-2s, and all your tax documents and your pay stubs. But back in the olden days, when you receive direct deposit, you also got a pay stub that will go with it. Nowadays, you don't get either one. And most people don't receive paper checks. Unless, I want to say, for example, like, let's say, and this is a lot, let's say there are people that do receive paychecks and they don't have bank accounts, so they have to go to the check cashing place. And you'll see a lot of that. But majority of most people have everything on direct deposit. So you're not looking at your pay stubs anymore. And you don't know what's on your pay stub. You need to look at your pay stub. So by her not looking at her pay stub, she thought that she participated in the 401k as of 2022. Come to find out, she did not participate in it. They was not taking out funds out of her account. Withholding for her retirement. If she would have never spoke to me today, and she would have never uploaded her pay stub, because she asked, listen, Mom, I'm going to be making more money this year. What can we do? Technically, why are you calling me in October? We should have went over this in March. Right after I did your tax return. We should have went over this right away. Not towards the end of the year. You're in the fourth quarter. So some of the strategies that I told her to do, if she would have did it earlier, it would have helped her more then than now. So I'm glad I have it in writing. So when she come back this year, if she owes, I'm gonna go right back to that text and what I instructed her to do today. So now she's eligible. She's coming up and eligible for enrollment into benefits. One of them is the 401k. Now she's going to participate in the 401k. So I told her to withhold 3%. Take your gross and minus it by 3% is going to let you know how much you're going to withhold every 2 weeks. That was important to her. So once we got through that, then I asked her another question. I said to her, do you know the difference between term life and whole life insurance? She didn't know. And as I mentioned to a lot of you guys back then, when I when a lot of you and I told a lot of you and a lot of you had found out that my father had passed away this past August, which was August 17th. And we had his funeral August 27th. So October 17th, he's been dead and gone. He's been passed away. He's been dead for 2 months now. And August 27th, October 27th will be 2 month anniversary, 2 months that we had the funeral. And one thing that I mentioned was many Black people don't have life insurance. Many of our people have life insurance, but don't know the meaning of term life or whole life, or don't know at all. There's a difference. So she didn't even know what term life is. I said term life means it can be broken down to a 5-year policy, 10-year policy, and 15-year policy. And let's say a 5-year at 5,000, 10-year policy at 15, and a 15-year policy at 20. So 9 out of 10, most of the time, term means it has a term when it ends. So if you have a 5-year policy and you outlive that policy, you no longer have life insurance, but there are some term life policies that you can convert over to whole life. So I said whole life means you have life insurance throughout your whole life. And you pay one rate. Whereas term life, yes, there are some term life policies that you can convert over to whole life. But when you're going for life insurance, you should always go for whole life. Again, when you're going for life insurance, you always go for whole life. Now, the one other caveat that I want to talk about is at the end of the year, you should be reviewing your benefits. You should be sitting down with your insurance broker, not only for life insurance, for auto insurance, home insurance. Don't you know sometimes when you combine and have multiple policies with one insurance company, you get a discount on your insurance? What is home insurance, auto insurance, life insurance? So you have, and even renter's insurance. If you have renter's insurance, some companies, you have like Progressive. If you have auto insurance, you take renter's insurance, they're gonna, since it's a double policy, you're gonna get a discount. So it's very important that you guys look at your pay stubs. I'm about to wrap up in a few minutes. I had another client lady came to me. She had moved from New York and she moved from New York to Florida. She had the same job. So she took a position because they had another company in Florida. This is what happened. When she moved, she never filled out she never did two things. She never filled out a new W-4, because now she was working and living in Florida where she had an old New York address. So one, she never filled out a new W-4 because in Florida, you don't pay state taxes. You only pay federal. So when she moved, if you move to any new location, you need to do two things. You need to fill out a new W-4, and you need to contact your human resource department, let them know that you moved. If it's the same company and they have companies in other states, let's say you work for Comcast. Yeah, they have a Comcast in Florida or California, and you decide to move to those states. When you move to that state, you need to fill out a new W-4. Why? Because you don't reside in Philadelphia or New York anymore. You work in Florida or California. So you need to fill out a new W-4 for the state that you reside into. She didn't do that. She didn't do that. Why? Because she didn't request a new W-4 and she never looked at her pay stub. I have another client. She did her taxes on TurboTax. And matter of fact, she's the receptionist at our office. Because I'm in a business center. I have an office. I have my own office. And there's other businesses there that have their own office. So she the receptionist. So one day she started crying. Oh, Marvin, I owe money. I said, what happened? You know what happened? Two things. Don't have an on-site human resource department. So now many companies, many employees have what they call an employee portal. What's an employee portal? That's where they go retrieve. That's where you go retrieve your pay stubs and your W-2s. And you have your own username and password, and you go in there and do what you go online. And sometimes you can download the app to your phone where you can look at your pay stubs. She didn't look at her pay stubs. Come to find out, she didn't pay no federal taxes throughout the year. Why? Because she didn't go in the portal and put down either zero, withholding. She didn't put down anything. So what happened was she didn't fill it out correctly because she was happy about seeing that this money showed up in her bank account every 2 weeks. So we're not paying close attention to her W-2, her pay stub. She could have resolved this issue if she would have looked at her pay stub. She waited till she filed her taxes and she ended up on it. She said, Mom, why? Oh, I said, let's go online to your employee portal. You got to put down zero withholding, and zero for the state, and zero for the local. Now, what I did was she ended up owing. We did a 9465 installment plan. Now she's paying monthly, and she was able to catch up on the taxes that was not withheld from her paycheck federally. So hopefully this year, we're on the right track. So when I do a tax return, there's a possibility she'll get a refund. Why? Because I'm advising a lot of you out there to, one, look at your pay stub to make sure you have all the right deductions taken out of your account from your paycheck. If you put down zero, that means you're going to have more taken out. You're going to pay more in taxes. So you have to be diligent enough to look at your pay stub. But the reason why you don't look at it is because everything is online now. So all you care about is every time you log into on your phone, to your bank account or your credit union or however you receive your direct deposit, all you care about is that money show up into your account, whether you get paid every week or every 2 weeks. That's all you care about. You don't look at your pay stub. You don't fill out your W-4 correctly when you start the job, a new job. If you move from one state to another state and you're working for the same company, you need to contact HR, let them know that you moved. And number two, you need to fill out a new W-4. And another thing, if you get a raise, you need to now talk to someone like myself, a tax professional, because now your income is going up. And you want to make sure you can also do two things. You can do an extra withholding, which when you go on your employee portal, you'll see extra withholding for the federal and the state. So you might want to withhold back an extra $50, $100, which is broken down to $50 for the federal, $50 for the state. Why? Because your income increased. You have no dependents. You have one job. You don't have a house. You rent. So really, the only thing that you have is your standard deduction. And if your income is high, what's going to happen? You're going to pay very little on taxes because now you're paying a share, but now your income is going up, but you have less deductions, itemized deductions. So what do? You do extra withholding, and you also do what they call estimated quarterly tax payments. And we're going to talk about that. So my name is Marvin Smith. Tonight's subject was, are you paying too much taxes? So I advise you to follow me on my YouTube channel, The Everyday People, The Everyday Entrepreneur YouTube channel. You can go follow me on LinkedIn at Smith Bookkeeping Financial Services, LLC. And if you have any questions, you can send me a message through Facebook Messenger, or you go to LinkedIn and send me a message, or you can email me at info@sbfsllc.com. Again, info@S as in Sam, B as in boy, F as in Frank, S as in Sam, LLC.com. And I say good night to each and every one of you. And I say good night to all of you out there. I wish you health, happiness, prosperity, success, money, love, and the abundance